after that.
Yeah. So welcome back, everyone. So anyone who wants to follow along with the Cenovus discussion, this Excel that I have open here is at the bottom of the website, whitetundra.ca. It's under Excel template or something. So you can download that and follow along. We will need some files from the Cenovus website. So if you just keep the website open, maybe, or if you just want to follow along and view, that's fine as well. For those who haven't been to one of these before, basically we go through the basic information needed to value some of these companies. You know, there's a lot of misinformation out there that you need to spend hours and hours and days to kind of get a valuation on these companies. And I've kind of simplified it down as much as possible. And then what I do is that once I run these basic calculations on a bunch of companies, I try to find the best kind of 5 or 6 or 8 companies that I want to do deeper dives on. And then, you know, the ones that are offering me the best free cash flow potential, the best kind of cash to shareholder potential, I will then spend, you know, a few hours kind of going to the deeper dive on asset quality, well quality, management, operational history, you know, et cetera, et cetera. So for this one, I've kind of changed up the way I'm going to run this one today. So we're going to go through Cenovus to the basic valuation, and Cenovus being one of the ones that is a big holding of mine and one that I did do a deeper dive on. I'm just going to go through maybe like a little bit of the deeper dive that I do and the things that I'm kind of noticing, making adjustments to my free cash flow models and such, you know, kind of to help people out who've been messaging me about what exactly do I mean by doing a deeper dive. There's a lot of things I can't really share given that I go through like a lot of well performance history and such that's not publicly available. A lot of info digging up the AER stuff and whatnot. So this is just the financial stuff that I do. There's a lot of other engineering and kind of other operational stuff that I would look at if there's any red flags or things that kind of pop out. But you know, this one will be a little bit more in depth. So yeah, so we'll get started. If you kind of fall behind, this will be recorded and posted on the website as well. So, you know, you can feel free to follow along there later on at your own time with all the documents open and such. So the first thing we need obviously is the company name. So for this presentation, we're going to do Cenovus Energy. We're going to get the production for the company. So what I do is you always want to get the most recent production, which today we only have Q3 results. So we'll go to the Q3 results on the website. Most of the information we need is under MD&A, Management Discussion and Analysis. So you can just download this file here. You can download all 3 files because we'll use them all. So under the MD&A, we're looking for total production volumes. So Cenovus, make sure you're looking at the 3 months ended September 30th, not the 9 months. You want the latest quarter of production. So it's 8048. You know, that's obviously multiplied by 1,000. So we'll go ahead and throw that number in here. The liquids percentage would be your heavy plus light plus natural gas liquid out of the total production stream. So for Cenovus, we would take the bitumen, the crude oil, the light oil, and the NGLs. So we take these 4 numbers and we divide it by the total production volume. You do that, you get roughly 82% is the liquids percentage for Cenovus. And then we're kind of going to divide them out. So because we're doing a deeper dive, we want to look at each of the production streams separately. Each of these oils gets priced at a much different pricing. You know, when you look at WTI versus Brent, it's very similar, but heavy versus light versus NGL, it's quite a difference. So we'll throw these numbers in here, which are, again, a lot of this information is very easily available. So heavy oil would be your bitumen plus your heavy crude oil. So it's 595.8 if you add these 2 numbers up. So I'm going to throw that in there. Light oil is this 23.8, and then NGLs is 35.5. So I'm gonna throw that in there. And then that gives you kind of what your gas production is in BOEs per day. Anything in yellow you got to put in, and then anything in white kind of calculates itself out with the way the spreadsheet is built. So the next thing we need is the number of shares outstanding. So again, that'll be in your MD&A. Sometimes you got to look for some of this stuff and kind of really find it. Where is it now in this one? Not in this one. So we'll go back to the financial. So if you go back here, we'll go to the consolidated financial statements instead, which sometimes has some of the information that is not in the MD&A. Well, that's a great start. Can't find it anywhere here. So there we go. So usually if you can't find something, just Control F and search for it. So as of September 30th, there's 2 billion shares outstanding, 2.018 million. So we're going to throw that in here. Again, make sure you put the units in properly in these spreadsheets, and then there's a little explanation on the side here if there's anything that doesn't really make sense. The share price on Friday close was 17.34. So we're going to put that in there. You can get that from Google or whatever bank you're using, and that gives you the market cap. The market cap tells you what's the value of all the shares of the company combined. So basically it's just shares outstanding multiplied by share price. It gives you the market cap of the company. We're going to look for the current debt that they report here. So if we go to the top of the MD&A, we see on the first page here, net debt is what we're looking for, 11,024. So I'm going to go back here and put that in. And that gives you the enterprise value. The enterprise value is the total value of the company combined. So how that is calculated is your value for shares plus the value for debt. So market cap plus current debt gives you our enterprise value. We have a debt to EV ratio, which basically tells you how much percentage of the company is debt. And that's important because when you're comparing a bunch of different companies, if a company has higher debt to EV ratio, I would expect that I want a better return to account for that increased risk, in that a lot of the company is debt as opposed to the value of the shares that I'm holding. And then of course, if your net debt is negative, so if your company is in a cash position, companies like Parex, for example, are net cash, you want to put your current debt in as a negative in here. And it's the same calculation. So if you have cash, basically your enterprise value becomes market cap minus the cash position that you're in. Debt capacity is something that I would look at for any company that has a debt to EV ratio, maybe more than 0.5 or 0.6. You want to look at the debt capacity, because if the company is right up against their debt max, you have a bankruptcy risk there. You have a chance that the bank pulls the line of credit, they run into problems, etc. For a company like Cenovus, I mean, it's a pretty blue chip stock. The debt to EV is pretty low, so I'm not going to look into this. The stay flat capital is how much yearly money does the company need to keep its production flat. And again, this is a comparison exercise. It does not go into the calculation at all. So if you have a company that has maybe X amount of barrels a day, but one requires way more money to keep the capital flat, you would want a higher rate of return to kind of account for that. With Cenovus, we're going to do it at the end here, so I'm just going to leave it for now. The annual dividend, Cenovus raised their dividend to 14 cents a year based on the Q3 results. So, you can find the news release for the Q3 results and get the annual dividend from there. And most investors, I think, would know this anyway. Your bank would have this, whether it's TD, RBC, etc. And this tells you the annual dividend cash. So the company right now is paying roughly $283 million in dividends in 12 months in the next year. So, compared to what the enterprise value of the company is, it's very manageable. It's actually a very low yield. When you think about it, it's less than 1% of the EV. It's less than 1% of the market cap. That's just the way that Cenovus kind of runs their show right now. The next thing we're looking for is the last quarter's adjusted funds flow. So adjusted funds flow basically tells you how much money did the company make after taking into account every single expense that they have other than capital costs. So employee salaries, you have operating costs, you have interest on their bank debt, you have tax issues, you have buying whatever stuff to keep their wells running. So after you take all that into account, how much money does the company make? So it's known as adjusted funds flow. It's known as free flow from operations. There's a lot of ways it's kind of said, but you want to just make sure that's what the definition of it that they're using is, that it's the money that the company made after all expenses except capital costs. So for Cenovus, it's 2,342. So $2.342 billion is what they made in Q3. Again, you want to look at the 3 months ended, not the 9 months ended. So we'll put that number in there. And the next one we're looking for is free cash flow. So free cash flow is how much money did the company make after all the capital they spent, because oil and gas companies need to spend capital to keep their production flat. It's a declining asset. So we need to take into account how much money did the company spend. And free cash flow tells us after they keep production flat, after every single cost is paid down, how much money did the company make? So again, it should be in the same MD&A. Cenovus calls it free funds flow. Some people call it free cash flow. So, here we see adjusted funds flow minus the capital investment gives us a free funds flow. So 1695 is the number we're going to throw in here. The next number we're looking for is a hedging impact. So hedging is always transitory, I guess, to use the word. It's companies hedge for a certain quarter and they hedge a certain amount of their production. It's not a long-term liability. So we want to take the impact of hedging out of the situation to know, okay, let's say a year or 2 or 3 down the road, when the company is not hedged, what's the actual cash flow generation? So we need to take these short-term impacts out of the share price or out of the calculation. So for Cenovus, the number we're looking for is right here. So hedging loss and gain is also called risk management loss and gain. It's also called, many other names that people use. And that's one of the issues that I think people get caught up on. But, hedging, risk management, and derivative contracts are kind of the 3 most used names. So we see that for the upstream sector, total upstream, Cenovus lost $168 million on hedging. So because it's a loss and the company would have actually generated more money if they hadn't hedged, I'm going to put this in minus, in a negative. So, and the comment kind of shows that, put losses in negatives. Share buyback last quarter. So we'll go through this in the deeper dive. So I'm just going to leave it for now. What we're looking for is this company made $1.86 billion last quarter unhedged, but at what price? The pricing for oil does not stay constant. It changes quarter to quarter. So we have one point in time that tells us the company made this much money, but we need to know at what price. So the number we're looking for is benchmark pricing is usually what I look for. You know, the company tells you exactly what pricing they got for every single product that they sell. You know, so Brent, WTI, gas, etc. So we're looking for this number, WTI. They got $70.56 a barrel US. Make sure they're in the right foreign currency, and every single column here or row here tells you which currency these things need to be in. So WTI pricing is 70.56. Last quarter WCS pricing, again, it's in the same chart, 56.98. So I'm going to throw this in here. Last quarter NGL pricing is not in this chart, so I'm just going to leave it for a sec. We want the last quarter AECO gas price. So, you know, AECO we have here is 3.54 Canadian. So I'm going to put that in there. We want last quarter NYMEX gas price, 401 US. So if we convert that to Canadian, that's going to be 510. Canadian companies report their gas in 3 different units. So gigajoules, MMBTU, and MCF. Unless you're dealing with a gas specific company, you don't really need to convert them. They all are roughly 1-to-1 to each other. And for the sake of this simple portion of the calculation, I'm just going to put them in as is. If it's a gas focused company, like for example, Birchcliff or Advantage, Pinecliff, etc., you might want to do the actual calculation, the conversions, and put in the right pricing. For NGLs, so for some reason, Cenovus does not put their NGL pricing received in the same chart. So we're going to look for the NGL price, which is not here. Search for NGL until we get some sort of price that they give us. So, okay, here we go. So we have NGLs getting $47.37 a barrel. I don't know why they don't put this in the other chart, but and when a Canadian company does not tell you which unit it is, it's going to be in Canadian dollars. So we have 47.37 Canadian dollars per barrel of NGL. When we convert that to US dollars, as the spreadsheet requires, it becomes 37.47. You can run the calculation yourself on a foreign exchange website. So the company made this money at this WTI. Well, this is not the actual WTI price that we're going to get over the next year or over the next quarter. So what we need to calculate is what we call strip pricing. Strip pricing is the pricing for these products over the next year. The best website for that I found is CME Group. So it's cmegroup.com, and all the links that I talk about today are also on the website, the White Tundra website, under links. All these links that I'm talking about here. So the way that we calculate strip pricing on WTI is we add in the contract for the next 12 months. So from January to December, we'll add these 12 numbers and we'll divide it by 12. And that gives us the average WTI price over the next 12 months. That's exactly what I've done here. So I've taken the 12 of it, divided by 12, and I get the strip pricing. So when you talk about, people on Bloomberg are talking about what's the strip pricing for WTI, this is exactly the calculation that they're running and coming up with these numbers. There used to be sources that kind of did this for you, but they've gone offline in the last couple of months. So we're resorted to have to do it by hand, which probably is a good thing anyway, because then we know for sure it is what it is. So So 75.69 is the strip pricing for WTI. Strip pricing for WCS is a little more complicated because WCS, which is Western Canadian Select heavy oil, does not trade on a per barrel basis. It trades on a differential basis. So what is the difference between WTI and WCS? That's how it trades. And again, it's on CME Group, Western Canadian Select futures. We do the exact same thing. We take the next 12 months and we divide by 12, we get 13.21. So this is the average difference between WTI and WCS for the next 12 months. So what we need to do is we need to subtract this from the strip WTI price to get the strip WCS price. Does that make sense? Yeah. So we'll take this 13.21 and we'll subtract it from the strip WTI price. So we get 62.48. So 75.69 minus 13.21. That's what we get. The strip price for NGL is very hard to find unless you have subscriptions to these softwares and forecasting companies. So I'm just going to assume that NGL stays at the same price, which probably is not true, but for the sake of this, that's what we'll put in. What's nice about this spreadsheet is that it's built such that you can put in whatever number you want in here. If you're an NGL expert and you think NGLs are going to be $45, feel free to put $45 on there. It's very open to your own flexible best estimates to what you think the pricing is going to be. On the gas production side, if the company is selling gas, you want to be very careful which hub they're selling gas to. AECO pricing in Canada compared to NYMEX in the US, compared to Dawn in Ontario, and compared to TTF in Europe, as we discussed in the macro, is very, very different. And it can really affect a company's economics based on where they're selling this gas. So with Cenovus, most of their gas is sold in Canada, but they do have a Chinese gas offshore project. So they're selling at much higher rates there. So we definitely want to look at this in a little bit closer detail. So basically, we'll go back here to our MD&A. I'm going to go to benchmark pricing again. And I forgot to get the, oh, never mind, we did get that. So what we want to look at is AECO. How much production is in AECO and how much production is in the offshore Chinese gas field, which can be found. So we can kind of see that here where gas production is about 900 MCF a day. And then they're saying offshore, they have this many MBOE a day. It kind of tells me, okay, there's some part of it that's gas. When they talk about barrels a day, we can assume that it's 100% oil. But because both the conventional and the offshore have MBOE a day, we need to dive deeper and find, okay, how much gas is being sold in AECO and how much gas is being sold in the Chinese market. So the way that I would do that is look at Asia Pacific. So Asia Pacific, which is their Asian gas market, they have roughly 282 MCF a day of gas production. So what we're going to do is we're going to take this 282 and divide it by Cenovus's total gas production, which was, again, if we go up here, was this 897. So basically we're going to go 282.8 over 897.9. So about 31.5% of their total gas production is being sold in Asia. So I'm going to put that in. It's not AECO, it's not NYMEX, it's other gas. So we'll put about 32%. And naturally, that means 68% would be in AECO. Make sure these two numbers add up to 100%, or else the calculation kind of gets screwed up. What's the projected AECO price? So this is where there's a little bit of flexibility. Again, AECO used to have a strip price forecast online, but that has gone offline in the last couple of months. So what I'm going to do is I'm going to go to Gas Alberta market pricing for the next year. So, you know, if you take the next 12 months again for AECO gas and you divide by 12, what you'll find is you actually end up roughly at 354, which is what they got. Again, the spreadsheet is flexible. If you think AECO is going to skyrocket and average $5 a gigajoule, feel free to put that in there. The spreadsheet automatically will forecast based on whatever you think the price is going to be. This Asian gas here, what price did they get for it? So again, we need to go back to our MD&A. We'll go back to Asia Pacific. Natural gas realized price per unit sold, dollars per MCF. They got 11.56. So, you know, I'm going to put that in there. And what's the projected Asian gas price? Well, we really have no idea. But if we read here, the price we receive for natural gas is set under long-term contract. So Cenovus has a contract with the government of China or whoever is buying this gas to sell this gas at a long-term contract. So I would assume that they're getting the same price, despite Asian gas pricing being very high over the last couple of months. I think they're getting the same pricing. And that's it. That's all you need to do a simple analysis on Cenovus. And I'll explain these numbers here. This is the annualized last quarter free cash flow. So if the price of WTI and oil and gas stayed exactly where it was for Q3 of 2021, Cenovus would generate 74.52 million, so 7.45 billion of free cash flow in the next 12 months. That gives us a free cash flow yield of 16%. So compared to what the entire company is worth at the end of Q3, Cenovus is generating 16% of that in free cash flow. So why is that important? Well, 16% free cash flow means the company could pay a 16% dividend. They could buy back 16% of the shares. They could pay back 16% of their total company value of debt. So what they're going to do actually is a mixture of these. They're going to pay maybe, X amount of dividends. They're going to pay X amount of share buyback and deleverage a certain amount. And the base point is that this is all money that can come back to the shareholders unless they make further acquisitions and such. It's all coming back to you. So that's at last quarter's pricing. At strip pricing, that's what the company generates. At $80 oil, 90, 100 and such, so forth. These are the free cash flow yields that we're looking at. So, okay, that's great. How do we value the company then? What I like to use is an 8 multiple on free cash flow. So I don't want 16% return on these companies. I'm happy with a 12.5% return, which gives me about a 5% dividend. It gives me like 5% share buyback and a little bit of deleveraging, which I'm happy with to own such a blue chip company like Cenovus. So if I want the company to generate 12.5% of their free cash flow of their entire company every year, if you multiply that by 8 years, you get 100%. So that's where the 8 multiple comes from. It's 8 years of free cash flow should buy back the entire company. And that's the risk that I'm happy with. This is a model that's very widely used. Some people use free cash flow times 6 for some of the smaller names. I'm happy with 8 for a company like this. So I'm going to multiply the free cash flow by 8. That's what the entire company is worth at last quarter's pricing. We subtract the debt from that because we need to find out what the shares are worth, not what the company is worth. So the company is worth this, the shares are worth this. And if you divide that by the number of shares outstanding, you get a fair share price of $24.08 at last quarter's pricing. At strip pricing, looking into the future, Cenovus to me is worth $30.30. And if you think oil is going to average $100 next year, the fair share price of Cenovus is $59.45. And it's just a rolling scale, right? And we see that at about $50 oil, the share becomes pretty much worthless. And that's why, you know, between when oil went from $20 to 30 to 40 to 50, you didn't really see a huge increase in the share value of some of these companies because, you know, according to this calculation, the shares were pretty much worthless until it hit $50. And then they really started picking up value from there on. Does that part make sense to everyone? Is there any questions on how I value these, where I picked up the information, etc.? Good. Cool. The other way that people can value these companies is on a adjusted funds flow model. So if you're a follower of Eric Nuttall, you'll see he uses a lot of these adjusted funds flow charts, and you know, it's just a different way of valuing these companies. It's a little easier because you don't need to take into account how much money are they spending to keep production flat. You're basically just taking into account how much money do they make flat out. And on adjusted funds flow, I like to use a 4 multiple. Again, some people like to use a 3 multiple, 5 multiple. I'm going to give you the most common one is usually a 4 multiple. And the exact same calculation is being done here. And you have the exact same fair share price values. So the way that I run these things is that I'll do these calculations. I'm tracking 55 companies right now in the Canadian market. I'll run these calculations after every quarterly release. I'll find the ones with the most potential. So if I think oil is going to average $90 a barrel next year, I'll take this fair share price and I'll divide it by the current share price. Okay, I have roughly a 200% gain I can get here. I'll find my top 5 or 6 or 8 companies, and then that's when I do the deeper dive and kind of go into hedging and all kinds of other things here, which we'll go through. But you know, if the company is not even generating the kind of rates of return that I'm looking for, why bother going deep into their well performance, their financial performance, and operations, etc. We'll just go with the main. You know, we'll just throw it out right there as a potential candidate. Okay, this company is not generating the cash flow I need, so I'm going to throw it out. That makes sense? Any questions? Anyone who's following along, putting the numbers in, is there any questions? So there's a question on what are my top 5 stocks. So if you go to the White Tundra website, whitetundra.ca, my portfolio and then my White Tundra portfolio are on there, and the weighting of each stock is on there, I believe, in transparency. So you know, it's all open there. It's updated monthly, and I'm happy to discuss deeper on any of those names. You know, if anyone has any questions. But okay, so once we've picked our top 5 or 6 companies, now we want to do a deeper dive as to what's affecting them over the next couple of years, over the next year. How is this company changing? So first of all, we want to look at hedging. This cash flow for the next year is obviously going to be is an unhedged number because we took hedging out of the equation here. So now we bring it back in, but instead of looking at Q3 hedging, we look at the next 4 quarters of hedging and how it's going to be affecting the price. And usually, so it'll be under risk management again. I don't think it's in here. I think it's in. I think this one is in the financial statements. But these 2 documents basically give you everything you need. You don't really need to go too crazy on going deep into the company websites and such. Basically, you need the MD&A and the financial statements. So for Cenovus, they tell us straight up what's their hedging situation. And Cenovus, being a fully integrated company, does not hedge as much as some of the other companies. So it's not as important, but we'll still put it in there because, I mean, it could affect the final numbers we're seeing, and we're doing the deeper dive anyway. So what we're seeing is that they have a contract to sell WTI at this price for this many barrels for this term. So they give you everything you need to know. And they also have a contract to buy WTI at this price, this many barrels at this term. So what we see is that from Q3 end, which is our calculation here, we did the calculation on September 30th, 2021 numbers. We have a year from there. So from October 2021 to September 2022 is the hedging we need to take into account. And it's pretty easy for Cenovus. Basically, these two prices are almost the same. So they're selling this and they're buying this. So the net is that they're selling 34,800 barrels. If you take 55.9 that they're selling and they're buying 21.1, it's 34.8 for the entire year, which definitely makes our calculation easier. So for every quarter, it's all the same. We're going to put the same number in here. And the pricing, 67.29. Let's take that. And again, all in Canadian dollars. So that's roughly 85.08 Canadian. So we'll just copy that in here all over the place. If it's a gas company, you want to look at gas hedging as well. Cenovus is not a gas company and they don't hedge gas. So I'm going to leave it blank. It calculates all of this for you. So they're going to lose $13 million next quarter on hedging. And the future year impact is this at last quarter oil, and obviously as the oil price goes up, they're going to lose more and more on their hedges because the hedges are at $67 a barrel. So this chart gives you the exact same numbers that we got on this chart, the free cash flow times 8 model, but with hedging built in. So, even with all their hedges losing money, how much ever they are, at strip pricing, Cenovus is worth $29.77 to me. So, that's roughly a 70% gain from where we are today, which, I'm pretty happy with that. And if you look at all 55 companies that can be tracked in the Canadian index, Cenovus to me offered a very, very good risk reward. So I said, okay, let me look at this company more in detail, even more in detail. What's going on? Is there something I'm missing here which can greatly impact this cash flow? And with Cenovus, there is actually a lot of things that are impacting this number. So the first thing that I would do is that we're in January 2022 already. So I want to look at Q4 free cash flow. What is the company going to report come Q4 results on February 8th? Are the results going to be good compared to how the share price has increased in value over the last 3 months? Am I still happy with these free cash flow yields after Q4? So, we'll do a little bit of projection. I usually compare it to what the analysts project, the EPS and the cash flow. And if my own calculation for some reason is showing a much higher free cash flow, I will try and play the earnings releases. As I did with Suncor, for example, in Q3 release, their free cash flow was coming out much higher than what some of the analysts had predicted based on these calculations. But anyway, so if we want the Q4 free cash flow analysis, we need the Q4 pricing. So just how we got the Q3 pricing and we ran numbers based on that, now we need the Q4 pricing. So how do we get this? So The EIA website, which is the U.S. Energy Information Administration, gives us the Cushing, Oklahoma WTI price, the closing average price for the month. So 2021, we have October, November, December would be our Q4. We take those three, add them up, and we divide by 3. We get our average Q4 WTI price. So it's about 77.45, let's say. So I'm going to put that in there, which is really exceptional. It's one of the best quarters we've had in a long, long time. Okay, so we'll close that. And then we have now we need the Q4 WCS pricing. So again, WCS pricing can be had on Statista. We have October at 69.3. We have November at 65.25. The December numbers, we don't have them yet. So we're going to have to guess a little bit. So what I'll do is we take our December pricing for WTI, which is 71.71, and we put a differential on it. So in December, the differential was a little bit higher. If you were tracking it throughout the year, it was roughly $14 a barrel, maybe a little bit more than 14. So we take 71.71, we minus 14, we get the WCS price for December was 57.71. So 71.71 minus the differential gives us 14. So I picked a different number here, but again, take the 3, add them up, and divide by 3, you get 63.75. So I'm going to put that number in here. Q4 NGL pricing, what did I put? So because we don't really have a good source on NGL pricing, I'm going to take the Q3 pricing, and I just know tracking the market that the price was roughly 10 to 15% higher. But for the sake of this calculation, I'm not even going to change it. I'm going to leave it as is. So I'm going to put 37.47. I'm going to go conservative because NGL is very, very hard to model, given that some of it is butane, some of it is propane, some of it is other NGLs. So we don't really know 100% on that. Q4 AECO gas price, I want to say is roughly $4. I don't have a source for this. If someone can share a source for historical AECO pricing, I know PSAC used to track this, but they went offline again. $4 Canadian. Other gas price would be, again, our Asian gas price, which is on a long-term contract. So it goes to 11.56. So I'm going to put the same number in here. NYMEX, I'm going to assume the same as it was in Q4. And again, feel free, if you have more accurate numbers, or if you think Cenovus had some sort of edge on their NGLs where they got $50 a barrel, feel free to put that in there. This spreadsheet is not meant to be a end-all be-all. It's supposed to be flexible. It's supposed to be open to interpretation. And if you have better sources than me, by all means, you can get much better accuracy on what's going on here. So the other thing with Cenovus to keep in mind is that, and this requires a little bit of knowledge as to kind of what's going on with these companies. When Cenovus bought the ConocoPhillips assets in 2017, they made a deal where Conoco would get a contingency payment. If the price of oil spiked, Conoco had this little extra little boost in there where they would get money if the WCS price was more than $52 a barrel. And this, again, I can't give you a source to all these things you need to see. It's more of a, as you do more of these analysis and you read more of these financial reports, you read more of these MD&As, you will kind of pick up these things as to where the money is going. So if we go to when the transaction happened, when the Conoco Cenovus transaction happened, they tell us clearly here how the deal is. On a 5-year time horizon, Conoco will get from Cenovus $6 million multiplied by the difference between the average WCS price and the threshold price of $52. And then I believe this is in US dollars, I want to say. Okay, so 6 million multiplied by the difference between 52 and the actual WCS price. So in Q4, the WCS price was $63.75. So from 52, that's $11.75 extra, and we multiply that by 6. So the Conoco contingency payment would be 11.75 times 6. So Cenovus paid roughly $70 million to Conoco in Q4. So not a huge impact, but it's important to keep these things in mind, because if the WCS price went to $80 a barrel or $90 a barrel, it's going to be a huge payment that they're making. So you really want to keep track of these things on the companies you're invested in that can have a huge impact. Athabasca Oil is kind of a big one where people are forecasting crazy cash flows, but Athabasca is stuck in this contingency payment with one of their deal makers, and it's up to 15% that they're paying on the profits, on the not even profits, but the pre-profits WCS price, which greatly impacts cash flow. Just a little digression there. So after we get all that, I mean, we can kind of think, okay, is there anything else that can affect Cenovus? They had some asset sales and stuff, and we'll talk about that in a little bit here. But for Q4, these are the projections. They're going to have roughly $3 billion in adjusted funds flow, and then $2.36 billion in free cash flow. Don't know what this is. So we also want to take into account interest. So companies go bankrupt when they can't pay interest, when the banks have to foreclose on them on their debt. So in Q4, Cenovus is going to pay roughly $130 million in interest, and we take their entire debt, we multiply it by what they're paying on their debt on average, and we divide it by 4. That gives you the quarterly interest cost. Interest coverage ratio, with the free cash flow that they're making, they can pay their interest 18 times over. So would you be concerned about a bankruptcy risk with a company like this? Probably not. Yeah, so there's a comment about the COP payment, and I'll kind of get to that, because the contingency payment only runs until May 17th of 2022. So this is a 5-year contingency payment. And if we look at when the deal was closed, it was closed on May 17th of 2017. So on May 17th of 2022, this payment completely ends. So Cenovus got very lucky where they barely paid anything to Conoco so far. And now that we're going into this structural bull cycle, this contingency payment is going to end. So, they've done really well. They got lucky a little bit on that. So the other thing to keep in mind with Cenovus is that when Cenovus bought Husky, they got all these preferred shares that came with the company. So if you go to TMX, the TSX website, Cenovus has 5 classes of preferred shares. And again, if you go through the MD&A, you kind of read through these things, it will tell you all these things straight up. If you look at their Q3 news release, they talk about the 5 preferred shares and the dividend, which should kind of clue you in that, okay, this is something I should probably be looking at as to kind of what's going on here. So what I did is I went to TMX Money, which is the TSX website. I checked out all the 5 series of preferred shares. I went to the market cap and I added them up. What's the value of these 5 preferred shares combined? and I got a value of $798 million. So these are additional shares that on first glance are not obvious. Google doesn't show them under their shares outstanding. Yahoo Finance is not going to show them, but read the news release, read some of the MD&As, and you will clue in to some of these things. There's comment here about 2 years left. Yeah, there's not 2 years left. The contingency expires on May 17th of this year, of 2022. So there's roughly 5 months left. So if you take this contingency payment for the quarter, you multiply it by 2 or even 3. It's not a huge concern, but if we were looking at the same spreadsheet 3 years ago, and if we were in the same structural bull cycle, I would have been concerned for this contingency payment. It could have added up to billions of dollars a year if WCS went the way that it's kind of looking. But given that there's only 5 months left, not really concerned too much. So the next thing we need to look at is the Q4 dividend. How much money did the company pay in Q4? That's going to come off this free cash flow. So free cash flow is always pre-dividend, pre-share buyback, and pre-debt payback. What the company chooses to do with this money is totally up to them. So in Q4, the company paid 3.5 cents a share on our share count, which was if we go back up here, our share count was roughly 2.018 billion shares. So the company paid roughly $70 million in dividends in Q4, or is going to pay. The preferred dividend, on these $798 million of shares, what's the actual dividend? So we go back to the Q3 report, and we'll just look at preferred shares, and it'll be somewhere in here. Not under this, so it'll be under the financial statements. So right here, so dividends paid on preferred shares was $9 million last quarter. So we'll just assume it's going to be the same. The preferred share dividends don't change very much. They're pretty constant. So there's 9. How many shares did the company buy back in Q4? We know Cenovus started a buyback. That's what they told us anyway, on the Q3 release in early November. So the company did spend some money on buying back shares. How do we calculate that? Well, CEO.ca is the best source for this. We can kind of tells you day by day how many shares did the company buy back and what it cost them. So, my calculation tells me that they bought back about 9 million shares in November. They didn't start their buyback till November 9th, we see. So if they bought back 9 million shares between November 9th and November 30th, how many are they going to buy back in December? We just run an extrapolation on that. Let's say they buy back 13 million. If it's 9 million for 20 days, it's going to be roughly 13 for 30 days in December. We add those two up, they bought roughly $22 million shares. How much money did they spend on this buyback? So we don't really know exactly. Like, you can add up all these amounts and kind of go super in depth, but it's really not important. Just look at the average price they're buying them at, and pick a number that makes sense to you as an average. For me, I picked $16. So in Q4, Cenovus spent, of this $2.36 billion that they made, they spent 71 on dividends, they spent 9 on the preferred dividend, and they spent $350 on the buyback. So, okay. What else affected free cash flow for Cenovus in Q4? Well, if you're a shareholder, you know that Cenovus had a couple of asset sales that they closed in Q4. So the first one was this Wembley asset, which they got 238 million in December. And then the next was this Tucker asset, which they got 800 million in, it says late January. I'm going to take it as a December sale, just because it makes the math a lot easier in Q4. I mean, for all intents and purposes, they're going to get the money before they release their Q4 results. So, 800 plus 238, they got another $1 billion and $38 million of cash. And then everything is calculated for you. So at the end of 2021, which is at the end of Q4, they have this many shares outstanding, which at this share price, again, we have a new market cap based on the shares, and we have another net debt. We have the actual net debt. So how this is calculated is the company got this much cash, 2.3 billion. These are the uses of cash, and then they got another this much cash, which all goes against debt because they didn't buy back any more shares. We already took the buyback into account. We took the dividend into account. We took any other cash outlay into account. They didn't buy any assets. So technically, it's a cash position which goes against net debt. So if you're a shareholder of Cenovus, when I ran this calculation, I was extremely excited because Cenovus said that when they reach a net debt target of $8 billion, that's when they can really amp up the shareholder returns, the buyback and the dividend and everything else. So on December 31st, Cenovus had almost reached their net debt target already, which means that when they release their Q4 results on February 8th, they will be well below what they were targeting. And, what am I projecting? I'm projecting that on the news release, they will say, look, we've reached our net debt target and we're going to increase the dividend. We're going to increase the buyback. We're going to, X, Y, and Z. And what happens when those kind of factors are news released? You get this huge bounce in the share price, a la Suncor in Q3 results. And, just to kind of go share my investment strategy a bit, this is why I bought a bunch of Cenovus shares and I bought Cenovus options for February, trying to play this news release, because the numbers show it's pretty obvious that they've met their net debt target, and the rest of the cash is coming back to us. And when that news release hits the market, it's an instant bonus to those who are invested, and the generalists and the funds are now looking to buy in, especially if the dividend is increased substantially. A lot of these people who look for dividends only are now going to go and be buying this as kind of their monthly payments or their quarterly payments. Any questions on that, on the Q4, how we calculated the Q4 projections and free cash flows? Good. Okay. So what I would do after this is, once I have my Q4 number and I'm happy with the holding, I'm going to keep my holding, I'm going to increase my holding, etc. Once I've made that decision, I look out to the next year. What is 2022 looking like for Cenovus? What changed? What's happening? So because they sold the Wembley asset and they sold the Tucker asset, it's going to make an impact on their cash flow from Q4, because this money that they got in Q4 included the profits from Tucker and Wembley. But now that the assets are sold, we need to take that out of the equation. And how does that impact the free cash flow going forward? So let's do the Tucker sale first. It's easier to do. So basically, I'm going to go back to my financial statements. I'm going to look at, MD&A. We'll look at Tucker project. So, we have the barrels. It produced 20 20,600 barrels, so 20,600 barrels in Q3. I'm going to assume it's the same, so we put that under barrels. You know, keep going. We need to find how much money did they make on the Tucker asset itself. So, you know, we see Foster Creek, which is one of their biggest oil sands producers for Cenovus, cost them roughly $10 a barrel. Christina Lake was $8, and then the other oil sands, everything included, was about $16. So what we can kind of guess is that, you know, Tucker is roughly $6 a barrel higher operating cost than the rest of Cenovus. Like Foster Creek and Christina Lake make up, I want to say 80% or even higher of their heavy oil production. So, you know, this is why they sold Tucker, because it's costing them so much more a barrel to produce oil. And then if we look at the netbacks, the netback is the profit generated by each barrel in this segment that we're looking at. So within heavy oil, each barrel made them roughly $37. So I'm going to put that under netback, and then extra cost. We talked about this here, where Tucker is costing them an extra $5 to $6 a barrel. So I'm going to put $6 in here, and then the change in price. So the change in price would be, this netback is at Q3 pricing. So we need to adjust it for 2022 pricing. And the way we would do that is we look at Q3 pricing for WCS was about 57. The strip is roughly, where did we calculate the strip? The strip is roughly $6.50 more than, or $5.50 more than that. You put that into Canadian dollars, it's roughly $7 extra that the buyer is now getting, and you know, we get the change. So Cenovus got $800 million for the Tucker asset today, but they're not going to get $286 million of profit every year going forward from the asset. So asset acquisitions and dispositions go both ways. Like, yeah, you get the cash upfront, but you need to subtract it from what the company is projected to make going forward. And, you know, Tucker is not a huge asset, so it's not super important, but when a company sells off 20, 30, 40% of their production or adds that much, you really need to take that into account. You know, Wembley, I'm just going to copy the numbers for the sake of time. But basically, we did the exact same calculation that we did for Tucker for the Wembley asset, and we find out that they got $238 million for it today, but they're losing out on $42 million of profit per year. So whatever asset acquisitions have happened, you take them all into account, or asset dispositions, you know, because it does affect the cash flow at the end of the day. The next thing for 2022 is the Conoco contingency payment. So the payment is till May 17th, which is roughly 4.5 months. So 4.5 months is 1.5 quarters, right? If you take 3 months a quarter, the fact that they have to pay these for 4 months, that's 1.5 quarters times the 6 million, which we've calculated before, and then times how much is WCS more than $52. So if we look at the strip pricing, it's roughly $10.50 more than 52. So 62.48 minus 52. So we'll multiply this by 10.48. So it's roughly $94 million that they still owe Conoco based on the strip pricing we have right now. We get our projected adjusted funds flow for 2022, and we need to subtract capital from that to get the free cash flow. So, you know, we look at what Cenovus has said. They are projecting a where did I put it? So Cenovus in their 2022 budget that they released on December 8th on the investor day said their capital was going to be between $2.6 and $3 billion. So we'll take the midpoint, 2,800, and that gives you what our projected free cash flow is for 2022 at strip pricing. You know, other free cash flow sources, we have the retail sale. They sold the gas stations for $420 million. So I'm going to throw that in there, and you get your 2022 actual deep dive projected FCF strip. So it didn't really change much from our unhedged. You know, our initial number was 19.6. You know, we're looking at 20.3. But once I do this deep dive on the financial end, I'm more happy with my purchase because I know there's nothing that's going to come out of nowhere that I've missed and it's going to affect my you know, my calculations. It's going to affect the free cash flow that I'm looking for, that I've calculated I'm going to receive. You know, and then usually I do the same calculation for 2023 as well. But again, for the sake of time, I'm just going to leave it, and I'll just upload my final Cenovus you know, spreadsheet for anyone who wants to run numbers yourself. You can kind of go through these things. And yeah, so once I do that, you know, I see that Cenovus is looking good 2022 and 2023, and it's a good investment, and I just kind of go from there. Any questions on that? Anything so far on the spreadsheet end of things? I know it's a little more complicated than we usually run these things, but you know, that's what I do. Some people had asked me about the deeper dive and kind of what exactly does it mean. So this is what it means. You know, just going through some of the things that affect the company that are unique, and yeah, you kind of get, okay, Cenovus today after Q4 trades at 20% free cash flow yield, and you know, when you're reading these charts from Twitter and stuff that tell you how many years of free cash flow can the company go private or whatever, this is the calculation that they're doing. This is where they're coming up with these numbers. So there's a question on the projected share price, so I'll just leave this open here. You know, depending on where you see oil price heading in the next year, these are the fair share prices on 8 times FCF. And then there's a question here about buying in the money warrants rather than calls. And you're right, you can play the warrants as well. The Cenovus warrants are something that are not taken into account in this calculation, just because they don't make a difference, is what I found. But the reason I play options as opposed to, or the reason I buy options as opposed to the warrants, is because the options give me a better risk reward scenario. And you know, for those who are interested in options, I'm hosting a quick 1-hour session on call options tomorrow at 11 o'clock in the morning. It's going to be 30 to 45 minutes, you know, maybe an hour, as to how I value options and why I buy options instead of warrants and equities in certain cases. So maybe I'll leave that question for then, but I'll just say that the options to me offer a better risk reward than the warrants, which are all the way out to 2026, and you're just paying too much time premium to get any win from the share price appreciation compared to what you can with options. Yeah, so that's it from my end. I'll leave the floor open. If there's any other questions, anyone wants to comment on Cenovus, etc. And then if not, I'll kind of end the Zoom meeting, and then we'll move to Twitter I guess we can continue the oil macro discussion and such there. But there's a question here about if I have to choose one or two stocks next week, which one would you put your money in? I'm a little wary to answer questions like that, but with the disclaimer that it's not investment advice, I will say that the last week of trading, I purchased ARC Resources. I see a lot of potential in this company. The dividend is good. The share buyback is going strong day after day after day. It's getting bogged down by 7th-gen shareholders kind of selling their shares still. But as soon as it's out of that, I think it will do really well. So that's one I've been kind of buying and adding to, and I've been pretty transparent about my belief in ARC and the short-term price dislocation that it's currently in. And then other than that, I did purchase i3 Energy kind of recently, about 3 weeks ago. So happy to discuss that more and such. But so ARC Resources, the FCF to EV from this exact same calculation that I've done here for 2022 is roughly 26%. Compared to Cenovus at 20%, ARC is at 26%. And that's kind of one of the reasons why ARC is a bigger holding for me. I see more juice in it. At the same time, I think, again, this is all my opinion, but I think Cenovus will benefit greatly from the fact that they've met their net debt target, and there's a big dividend increase announcement coming. So I think sometimes you have to take these subjective kind of things into account and time things. Just kind of what I'm thinking. And I'm also exposed to Cenovus with February options, April options, and June options. And then with ARC, I have the equity as well as I believe the September 2022 options with ARC as well. There's a question here on variable dividends. I don't think the Canadian oil producers seem to like that very much. Tourmaline is kind of a one-off example, but it seems to be much more of an American thing. And the fact of the matter is that if Cenovus was to declare a variable dividend and pay it out right now, they would again be over their net debt target of $8 billion. So I think it's going to be more of a slow cash release, at least for now, anyways. And we'll just kind of go from there. I think the Cenovus might also make a play at buying back the Conoco shares, as much as they publicly say they're not going to do it. There's about 80 million shares there they could buy back and retire in one smooth transaction. So that's another option there. So So anyway, there's a reason that ARC is my second biggest holding and Cenovus is my third biggest holding. And I go off free cash flow yield, and it hasn't really let me down so far. Sure, I've missed out on some opportunities, but you know what? It's all about risk reward. You don't want to play super risky names for minutely higher reward. The reward should go correspondingly to the additional risk you're taking. And it's all about a matter of perspective too. Some people seem to think that the new money coming into oil and gas is going to be into the blue chips, where some people are pretty confident that the money is going to come into the small and mid caps. So depending on how you believe that's going to go, you play certain names. So there's a lot of subjectivity to it. But if you do these calculations on your top 5 or 6 or 8 names, you can have that conviction that, hey, it's generating cash, and cash and dividends and share buybacks bring investors. And that is the reality of investing. And if you go with that as your baseline, and then you kind of go into the subjectivity of the management and operational issues and such. So, so I'll just leave it at that. There's a question here on Surge and why why it's my biggest holding. The reason I have Surge as my biggest holding is not because it has the highest free cash flow yield today. It's because my macro leads me to believe that much higher oil prices are coming. And if you look at Cenovus at $100 oil, we see a free cash flow yield of 35%, and Surge is at 50%. So it's cash flow torque and where things go kind of into the future, and where I see oil price going, because I don't see oil price staying in the $75 to $80 range for very, very long, 6 months out anyways. There's a question here on how much of my personal portfolio is in oil and gas as a percentage. So my personal portfolio is 100% in oil and gas. The white Tundra portfolio is maybe 95%, 93% in oil and gas. So, I'm pretty convinced, and I have a lot of conviction in these things. I don't really like talking to people who will keep giving you ideas and pitching you ideas, and then you find out they bought a starter position with $500 or something, right? It's just not moral, really. It's just a waste of time. So yeah. So I'll leave it at that. I'm gonna. Okay, so there's a question here as to at what point would I start trimming and diversifying, and the answer to that to me is when your buddy who's been invested in tech and crypto for the last 3 years starts telling you to buy oil stocks, that's the time to start trimming and diversify. So look at what the market is telling you, and I think there's a risk of selling too early in this bull cycle. There's a definite spike coming here, in my opinion, in 2022, when the world realizes what a crisis they've sleepwalked into. So I think, and I'll talk about this more in the options kind of seminar, is you're better off kind of buying puts on some of your holdings as opposed to selling outright, because you will miss a lot of gains by selling outright. There's a potential anyways for that. So yeah, can everyone still hear me? There's a question here that I lost the sound. Yeah, cool. So the next question here is about the green tax on oil. So again, I come back to kind of the same thing. Carbon tax is going to have an effect. We already have a substantial carbon tax. The royalty rates are pretty fair, you would say, in Alberta anyways. And I just don't think the Canadian government is going to shoot the golden goose in the head. I think they kind of work with the producers, and the producers are doing an exceptional job at reducing emissions already. Like, it's not like they're sitting around like some of these other countries with ponds all over the place and oil leaking into rivers and such. It's just not the case. And I think the industry needs to do a better job of projecting that and kind of sharing that. But at the same time, I think the government will just enjoy the money while it's, while it kind of comes in, and not kind of meddle too much in it. Yeah, so I'll leave it at that. I'll end the seminar